Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody, to another episode of Creating Wealth Simplified. I am your host, Chris Seveney, and today I am going to tackle the debate of passive investing in real estate versus active investing in real estate. Before we get started in diving into passive versus active, I want to set the ground rules and define my definition of active versus passive. For me, passive investing means after you invest, you have no decision making to be made. Active investing is you have to make decisions. I know some people think I bought a rental and I have a property manager, so it's passive. No, it isn't. That's not passive. That is active. Passive is essentially investing in a third party to manage the asset and provide you with a hopefully targeted income stream. So I'm going to talk about 5 pros and 5 cons of each. And I'll start out by saying there's no right or wrong answer to either one. And I'll talk more about that in my conclusion. So we will start first, passive investing. Again, for me, passive investing is investing in some type of offering. For example, our Regulation A+ offering. You invest $5,000, $25,000, and you rely on a third party to manage that asset and provide you, hopefully like we do at this point in time, monthly distributions. But what are some pros of passive investing? Number one, typically lower costs, lower barrier entry. You can get in. Now, there might be fees that get paid, like management fees or other types of fees, but it's usually pooled and it's a lower cost, meaning you can get in with a lower amount. It's very difficult to buy a piece of real estate for $5,000, $10,000, where you can invest in real estate passively for $5,000 to $10,000. That's a pro. Secondly is simplicity. Now, begging people that they need to go out and do due diligence on the offering, the sponsor, understand what they're investing in, know the capital stack. But once you understand that, it's easier to manage. Where am I getting paid or am I not getting paid? You're not, again, going through, was rent paid? What were my expenses? Why did I only get this much money? So sometimes it can get suitable or more suitable for people who do not have time or the experience. Another is performance. I don't like to say consistent performance with passive investing, but again, it's pooled. So I view it as, lower risk. If they're investing, it's a fund investing in multiple assets. Now, if it's one asset, it's a different story, but, it allows for, a performance to be diversified. Another pro talk about is, let's say, tax efficiency. You're typically both provide tax benefits. Now, it depends on your active side, whether you're fixing and flipping or whether you're buying long-term rentals. But passively, you're not an active member. So hopefully it contributes to long-term capital gains and you get some of those tax benefits. Lastly, it's less time consuming. After you get your due diligence done, it's really minimal ongoing research and monitoring. It's, did I get my distribution or not? Now, this is where I get into an argument or debate, I would say, not arguments, with people where if I'm investing passively, I would rather invest in something for 5 or 7 years so I set it and forget it and not have to find a new investment. I know some people are just such control freaks over their money that they just want to go chase opportunity and be able to get their money in and out of deals or have that liquidity, which reality is, I think they show research. People who jump investments more frequently typically perform less. Now, on the real estate side, I know that was kind of the case when I was moving a lot from 2001 to 2005. And you buy a house, make some equity in it, sell it to move up to another house. Because I was making more money, but I also was making money off, making more income. But when you look at every selling transaction is, 5-6%, all of that gains typically go away. So again, 5 pros, typically lower cost, easier to manage, diversification, tax efficiencies, less time consuming. Of course, there are cons. Limited flexibility. You are locked in to that sponsor based off of the terms that you signed up for. That can be a con. Things aren't going well, not much you can do. You can't cut your losses. You can't do, a sell order typically on the asset, especially if it's in an alternative. So something to realize, again, why it's so important to understand your sponsor. Another con is, and this is whether you're passive or active, but there is just that market risk. You're exposed to that downturn, but doesn't give you, again, that flexibility to get out. You're kind of just tied. Another is lack of customization. What do I mean by that? Is you can customize which funds you invest in, but you really can't tailor, you can't adjust the offering. You can't negotiate with a sponsor. I find when you're active, which I'm of course active, and I invest passively, I can control things better, or move their chess pieces a little bit better and customize things and adjust risk, I think, a little bit better than you can do investing passively. But it takes a ton of time, and it's not really an overwhelming con compared to active. The next is significant reliance on the sponsor. You are relying 100% on that sponsor. And if there's underperformance, you could miss out on higher returns through other opportunities because you're locked in. As I mentioned a minute ago, I'd much rather be tied to a 5, 6, 7-year investment. Of course, that's if it's going good. If it's going bad, then it just feels like, death by 1,000 cuts. That is the risk that people take. And understanding risk is so important in real estate and making sure you understand every aspect. The fifth con, and this is the one I think I see the most, and these are actually types of investors, honestly, we don't seek these types of investors for our fund because they're not a right fit. And that is, it's boring. I'm at a point in my life that, my late 40s, where we go to a water park, I'll do the lazy river. I want slow and boring. That's how I want my investments. The lazy river. I don't need the wave pool. I don't need the water slide or the river rapids that you get flipped over in. It's cool. It's fun. It's exciting. It's thrilling. Is that how you want your investments? Call myself a goat. And no, it's not the greatest of all time. Getting old and tired. Some of these active investments. Now, I run a company that is active. I love that. But for my own personal portfolio, which is how also I manage our fund, I want it to be boring. We look at our loan to value on the assets we buy and, where we structure our fund. I like to say we're a boring fund. We target hitting singles and doubles. People don't go to the baseball stadium typically to hit singles and doubles. People who do, those are the investors that we want. People who are chasing returns, typically they can go chase returns in other offerings. So that is a con. So spend some time, pros, cons of passive. If you have questions, reach out to us. Happy to answer them. Happy to debate this even further in another podcast. And now let's flip to active. Pro, higher returns. Well, of course, you're managing. You're spending time. But what's the cost of your time? So something to understand. Of course, it should be because you're paying somebody to manage that time. You're paying somebody to perform a skill. Now, if you don't have that skill set, maybe you shouldn't be active. But if you have that skill set, of course, you should have higher returns when you're active. Second pro is more flexible. You can adjust your portfolio quicker if you're doing fix and flips, one's taking longer, you can pause or, shift things around because it's more dynamic. Because it is liquid, it's more dynamic, so you can respond quicker to things. It gives a little bit more flexibility. If you're in one fund that's not going as well and you invest in others, not much you can do unless you're using new funds to invest. So active does give you a little bit more flexibility. It also gives you a little bit more customization in regards to, how you structure things and how you go after different assets. And last, pro, but it's con is, that risk management side of things. Managers can use various strategies to hedge risk. Many don't, honestly, when it comes to being active. Most people are chasing money all the time. But if you're good at being an active investor, then you are managing the risk versus somebody else. And, again, it could be a pro or a con. Last is that engagement. Again, the thrill, the seek. It's more engaging for investors who enjoy the challenge. They want to go down the river rapids, because it's more thrilling, but it could provide a higher return. More engaging. It's more exciting. So again, it depends on where you want to be. So those are the pros. Quickly run through those. Talk about some cons. It could be higher cost. Now, what do I mean by that? It's tough to get in real estate actively with $5,000 to $10,000. People can do it. But even note investing. I was looking at a loan the other day. I was just scrubbing some old funds I had. I had a loan I bought for $3,000. I had $20,000 due in taxes. Payoff at the time was like $70,000. So I knew I'd have to pay the taxes. But I paid the taxes, had to continue to pay the taxes, and spend about $20,000 in legal. I was into this loan that started at $3,000 for $51,000. Same thing can happen if you're an active in real estate, because you can go into a fix and flip thinking you're going to spend $25,000. Next thing you know, you're $50,000 into it. It's going to cost more. Next, it's time consuming to be an active real estate investor. I love being active, running our fund. It's time consuming. Even before I ran my funds, when I was just doing real estate and notes, I'd work a W-2, and then at night, have to respond to emails. And the worst is owning property, even have a property manager. You get that damn Sunday phone call where you're out with your family and toilet overflows, or your tenant threw potatoes down the garbage disposal and jammed it full potatoes. Yes, that has happened. Or your tenant threatens a lawsuit because your lead paint certification expired on Saturday and they don't have the renewal, so they're threatening to sue you because they want out of their lease. Yes, these are all things that have happened. So it is time consuming. It's sometimes a little more stressful. It can be more inconsistent on the performance side. Returns can fluctuate. If you're a fix and flipper, you can make pause. Tenant, stops paying. You have expenses some month. It's, if you're in a decent fund that pays a distribution, that's usually going to be more consistent. Again, we talk about taxes could go either ways. Either way on taxes. If you're active, typically, if you're getting into the ordinary income, that's a crusher. When I was doing notes, I remember I made some good money one year. I'm just going to use an example. Let's say it was $100,000 and I was still working my W-2. And then all of a sudden I'm like, great. And then 37% Uncle Sam and like 5% the state tax. And I'm like, everything. I'm like, wow, I just walked away with 50-something thousand out of 100,000 I earned. That sucks. It just sucks. Be taxes, long-term capital gains, 100,000 would only be 80. But, would you have made that much money? Who knows? But there's those tax implications. Last is vendor management and the stress along with that. You have to pick your property manager. You have to pick your team. If you're going with a sponsor, they have to do that. This reminds me of the time when I went from being a general contracting side to the developer side. And the joke internally of people in that space is you go to the dark side. And after 15 years on the GC side, yes, I got burnt out. And when I went to the development side, I was running call it $100 million project about 300 apartment units. And, very large contractor, guys were pretty skilled, talented, the superintendent, old school, basically hard knocks guy, loved them. And, he's like, oh, why'd you get out of this? Why'd you miss the thrill? And I looked at him, his name's Larry. I said, Larry, the benefit I have right now is instead of having to yell at 50 to 60 subs like you have to, I just got to yell at one person, which is you, and you got to figure it out. So for that, my job's a lot easier now. And it's kind of similar when you go from active to passive. When you're active, you have vendors and everyone you have to manage. When you're passive, just that sponsor that you got to chase and make sure they're sticking to their word. They're doing what they're saying. And kind of, people go through lives. And really, as I mentioned when I started, there's no right or wrong. You could do both. I do both right now. You could do one or the other. And as I said, there's no right or wrong answer to any of this. So if somebody's going to try and convince you otherwise, it really is based off of what fits their needs. If I have coworkers who have 2 young kids at home. Now, after they work their W-2, do you think they want to continue to be active, or do they want to spend time with their kids? Of course, they want to spend time with their kids and be passive. And I think a lot of people, especially millennials, who are starting to raise a family, understand from us Gen Zers and boomers, time is the one asset that you can't make more of. You can make more money, can do a lot more. I was brought up in, you work your butt off in that 9 to 5 and just try and work your way up. And, somebody finally told me the 40-40-40 rule, which is work 40 hours a week for 40 years to get 40% of your income. And, people would work nights, weekends, do whatever it takes. And that's how I started. Do I look back and, wish I did things differently? A few. I don't have any regrets. But I think times have changed where people are realizing the value of time. And, for example, in notes, someone invests with us and can get 8 to 10%, or do it on their own and get 12 on a $100,000 investment. Let's say pick a number, 10% versus 12. Is $2,000 really worth all that time and effort? Which is actually most likely less when you look at the net, because if you're doing it yourself, you're probably paying ordinary income. And in our fund, you're paying long-term capital gains, not tax advisor, but we issue 1099 dividends. So something to think about, is when you're active, what is that cost to be active? Not only monetarily, but time. How much time are you taking away from your family? So something to consider. I do want to thank everyone for listening to this episode of Creating Wealth Simplified podcast. As always, if you have questions, comments, go to our website, seveneyinvestments.com. We look forward to hearing from you. Take care. Catch you on the next one. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.